I recently did a video on long-term investing, and one of the issues that needed to be addressed was the importance of investor psychology as it relates to long-term investment outcomes. It's often said that investors should simply just put their money into the markets and that over time it'll all work out fine. But it's actually not the case. If we look at actual investor performance over long-term time frames, we find out there's a big difference between how investors actually perform over time versus the index itself. As you can see in this chart, investors over a 3, 5, 10, and 20 and 30-year period have always underperformed the index. Now, this is due to a couple of reasons. First of all, it has to do with the fact that indexes don't pay taxes, they don't pay fees, and they also don't get impacted by the burden of psychology and human emotion. That's the focus of what I want to talk about today. One of the big fallacies on investing is that diversification is a myth. Asset classes tend to become more correlated during market corrections, somewhat muting the benefits of diversification and necessitating a downside protection strategy that goes beyond just diversifying your portfolio. In other words, when the next recessionary market correction comes, not having a specific sell discipline or a hedging strategy is going to expose you to much more substantial capital destruction. We find out that poor recommendations isn't the problem. For most investors, no evidence has been found to link predictably poor investment recommendations to average investor underperformance. Analysis of underperformance shows that investor behavior is the number one cause, with fees being the second leading cause to long-term investor underperformance, but it's even more egregious than that. When breaking down the factors that lead to long-term investor performance, it has to do with three things. The lack of capital to invest, the capital that was supposed to be invested wound up to being needed for another purpose, but 50% of the problem of long-term underperformance is strictly due to psychology. There's 9 basic psychological flaws that all investors go through over time. The first is loss aversion. The fear of loss leads to withdrawal of capital at the worst possible time, also known as panic selling. The second is narrow framing. This is where we make decisions about one part of the portfolio without considering the effects on the total. Anchoring is the process of remaining focused on what happened previously and not adapting to a changing market environment. Mental accounting, well, that's separating out performance of investments mentally to justify either success or failure. Lack of diversification, believing a portfolio is diversified when in fact it's a highly correlated pool of assets. Herding. This is where you're following what everybody else is doing, and this is the one factor that leads more investors to the buy high, sell low problem of investing over the long term. Regret. Well, that's not performing a necessary action due to the regret of a previous failure. I don't want to sell that stock because the last time I sold it, it came back. Media response. The media has a bias towards optimism in order to sell products from their advertisers and to attract viewership and readership. Optimism. Overly optimistic assumptions tend to lead to rather dramatic reversions when met with reality. The biggest of these problems are herding and loss aversion. This is where these two come together in order to keep us from doing the things necessary in order to protect our capital from investment losses. So what can you do to do better in terms of managing your money long term? Well, the first thing is to reduce your expectations. Reduce your expectations. Markets don't return 8 to 10% every year, especially from current valuation levels. Control your exposure to risk. Risk is not how much money you make when you're right, it's how much money you're going to lose when you're wrong. Monitor your risk tolerance, periodically reviewing your financial situation and adjusting your portfolio risk accordingly. Measure your forecast in terms of possibilities and probabilities. Past performance is a useless exercise. When predicting your future outcomes or your expectations of what you think an investment will do, be sure and base it on a probability of success and weigh that honestly and appropriately. Follow a strict investment discipline. Not having a buy-sell strategy ultimately leads to the standard practice of buying high and selling low. So let me give you these 7 simple rules that are absolutely impossible to follow. The first is sell your losers short, let your winners run. This is the basic of all investing. When something's not working, let it go. Let the ones that are working continue to perform for you. Buy cheap and sell expensive. This is the opposite of what most investors actually do. Sell high and buy low. We want to make an investment where our reward to risk ratio is balanced in our favor. This time is never different. Believing this time is different has always been the downfall of every investor throughout time. Be patient. Let your strategy work for you. But also understand there's a difference between a strategy that's temporarily out of favor and one that's not working. So pay attention to what's happening with your money. Turn off the television. We've talked about this before. The media optimism will lead you to make bad investment decisions repeatedly over time. Risk does not equal your rate of return. As I said earlier, risk is how much you lose when you're wrong. Taking on excessive risk, while it may work in the short term, will ultimately lead to a poor investment and portfolio outcome. Go against the herd. This is the basis of being a contrarian investor. In the middle, the herd tends to be right, but on both ends of a bull market and a bear market, the herd is always wrong. So oftentimes, betting against the herd is where you can find the best opportunities for your money. These are the things that we want you to focus on in order to make you a better investor. And for more tips like this, more videos, and more articles, simply go to our website, realinvestmentadvice.com.